Are you ready to travel down your path to prosperity with us? Well, tonight we're going to take you from the head to the heart. So stay with us for this edition of the Master of Money starting right now. Tonight's Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to retail investors. Our special guest tonight is Mr. James DeGeorgia, principal of Golden Energy Options Trader and a specialist in the gold markets. This Master of Money program was produced Tuesday, March 17th, 2015. Hello, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and please accept a very happy St. Patrick's Day wish from me and everyone involved at the Society. We hope you have a fun day and celebrate some of the luck of the Irish in your investment portfolios this week. It certainly has been a good week for people. We'll talk about that later, but the markets have rebounded nicely from the doldrums they've been in for the last few weeks. Tonight's program I'm very excited about. You know, I'm asked all the time why people aren't building sustainable paths to prosperity. And the fact of the matter is there's much more to building wealth than just knowing the terminology, knowing a few tricks of the trade. There is most definitely an issue from the head to the heart, and that's the powerful psychology underlying people who build success. Well, tonight, I'm going to cover some of the reasons people emotionally don't become wealthy. If I had $1 for every time someone said to me, Steve, I want to be rich, and then I'm willing to show them. I'm willing to show them exactly what it takes, but they don't do it. And it's this emotional baggage they carry with them that prevents them from doing it. So tonight, we move from the head to the heart, and we're going to talk about the why people don't go about building their path to prosperity. Now, last week, we had a wonderful time with Tim Newell once again. Tim joined us to talk about comprehensive financial planning. And we talked first about the need for you and for me and for everyone to have a plan in place that's a living plan, a dynamic plan that can transport with us through life, that we can update and change regularly as our life experience changes. And then secondly, we talked about the need for it to be comprehensive, and thus that word, because we need these plans to cover everything from not just your retirement income, but your medical needs, your education needs for your children and your grandchildren, and even the charities that you want to support. So we were awfully glad to spend that time with Tim, and it raised a lot of very good questions from viewers. So like them, if you have questions, don't forget to write us at questions@safefinancial.org, and we'll get those answers to you right away. So once again, we want to thank Tim Newell from Harvest Investment Services for joining us last week. We'll have Tim on the program again. We know you enjoy it, and we do too. Tim is a good friend of the Society, and he's been a big supporter of our efforts. Now, looking at our viewer mail last week, we had a young person write us, and I'm always glad to have young people write who are just starting out on their path to prosperity. But a young fellow wrote me, and he said, Mr. Beeman, I understand what you're doing, and I love watching the program. Kudos to him for that. But he followed up and said, but I don't have any money to start with. Where do I start? Wow, what a good question this young person asked. And again, I want to thank them, not just for asking the question, but for taking the time to watch a program. Clearly, it's more geared toward adults, but it's something that if he pays attention over the series that we run, he'll learn an awful lot about building wealth in his life. So we were glad that he joined us for that. Now, the reality is I spoke to him and wrote back to him that starting out on the path to prosperity requires some knowledge. You have to understand some basics, but all of those basics are available on our audio libraries, available through safefinancial.org. So I sent him there to get some of that foundational knowledge. But number two, I suggested he began looking at things in stages. First of all, work to get $100 in the bank. Now, to many of us, $100 in the bank doesn't seem like much. But think back when you were just starting out. $100 seemed like the world. So I talked to him about getting that done. Now, every week, try to add to that to the point it can grow to $500. I mentioned to him that unique little program for smartphones called Acorns. Now, I've been using Acorns for a couple of months, and I've accumulated $500 in these little pieces they take, where they round you up to the next dollar and they take the difference. They invest that for you. So we talked about that. The idea is to use these kind of jars in the cupboard where, we all take money and we take it out of our pocket at the end of the day and we throw it in a jar. Well, young people do that too. They spend money at the movies, they do all these, so they can take the money like this boy and he can put it through Acorns or through a jar and he can start to accumulate some basic capital. But I explained to him that once he gets to about $1,000, now things can begin to change. We have on the program oftentimes Jeff Garbaz of Superstock Investor. Well, Superstock Investor has stock recommendations and option strategies that can be employed by people with just $1,000 in their capital. So I talked to him about that by a letter and explained that if you can get to that magic 4-digit number, you can begin using some of the strategies that the professionals use. Not a bad way to begin. And so once again, I salute that young man. I can only wish he had an influence on millions of other young Americans who will find themselves shortly saddled with college debt and other debts, unable to get their path to prosperity started. Well, hopefully for this young man, that won't be the problem. As always, I urge you and welcome you both to write us at questions@safefinancial.org, and we'll try to get you the answers to the questions that you need. Now, moving into the geopolitical world, it is getting to be a crazy situation, and we talk about some of these things week after week because they keep bubbling to the top. We talked last week about Greece, and Greece still remains on the front burner in understanding geopolitical issues that can affect your wealth. The Greeks are in a bad way, as we know. They've got too much debt. They've been borrowing money to survive. The last government that they had tried to put in austerity programs to cut back their necessary borrowing, but the Greeks rejected that, electing a socialist government a few months ago. Well, that government, with its Prime Minister Tsipras, went to the European community and talked about backing out on these loans. Well, the Europeans aren't taking too kindly to that. I think the Greeks have about 6 weeks to come up to a resolution of this, or they will default. Now, this is unprecedented. So the reason we're watching it, if the Greek government defaults on those loans, this will be materially impactful on the European Union, specifically the French and the Germans who've loaned them all that money. That will cause, I believe, the U.S. markets to react. All of these geopolitical things that we monitor together with you are set up so that if you don't have risk controls on your portfolio and one of them goes crazy, you're going to get hurt. So we want to always go back to say the professionals in the business, the people I know that run hedge funds and run real money, all of them have stringent risk controls. Well, you should too. Greece is one of these events that could turn on a dime and cause all of the global markets to shrink. So be aware of that. Secondly, I want to talk about our friend Vladimir Putin in Russia. This is a very interesting thing again. We've talked about Putin. You understand that he's a dangerous man. He's a dictator virtually, trying to put back not the Soviet Union, but old Russia. Well, on March 3rd, he kind of evaporated from sight. He hadn't been seen since then. And the world was starting to get concerned. I mean, this goes back only for 10, 12 days. But it turned out he came out today. But it shows you the concern the world has for what happens if something happens to Vladimir Putin in Russia. There is no backup plan. The fact of the matter is he is a singular power in Russia, and if something happens to him, Russia could fall into chaos. That's why there was so much concern. But when he came back onto the scene this week, he came out with a very aggressive stance, launching one of the biggest military exercises in Russian history. Now, we know he has openly stated his intents to get all of Ukraine. He's talked about Finland, which has a large Russian-speaking population. He's talked about pushing NATO just on the hard fringe. Poland just asked for all of its reserve troops to come up in response to Russia's war games. Now, we don't think that Russia's going to do something precipitous here, but I want to go back to you. If you're sitting on a portfolio that is wedded to a mutual fund or it's wedded to a group of stocks, get some risk controls on it. If Putin makes a miscalculation here and walks into the Ukraine, that could cause the global markets to drop. So keep aware of that. The geopolitical things, these are very important, and they just highlight, again, the nature of risk control. Economically, we have several things that are important. First, as you may have already heard, the United States once again came up against the debt ceiling and we surpassed it. We're at about 18.1 trillion in debt now. We've shrunk our deficits from years ago. They were at 1.1, 1.2 trillion, and now they're at about 460 billion. Still a big number, but the fact is the deficit has shrunk. As the economy's grown, tax revenue to the government has gone up. Well, that's all okay stuff. But here's what's interesting. We've talked about this really bipolar economy where some data comes out good, then some data comes out bad. Last week was a bad week. Industrial production data for February came out and it was dismal. That, together with some of the consumer sentiment numbers, which were bad, lead the economists of the world to say, well, maybe we're not out of this hot water yet. And that is what caused the markets to spike up this week. You saw enormous gains just yesterday following on last week's coming up to the point we're in positive territory for the year. And that's because bad news for the economy means zero interest rates competing with stocks. So that's the interesting part on the dynamics of the economic releases. Now this week, we don't have the data right now, but the Fed has a series of meetings and we're looking at the language coming out of the Fed to see if they're going to try to raise rates as early as late spring or if they're going to hold off till August. I'm thinking they're going to hold off till August, but I don't have a crystal ball. The point is, when they do start to raise rates, you can watch the markets come down. We want you to be in the market because it's got an upward bias, but we want you to have risk controls that can get you out if it turns south. Let's not forget that. Keep a close eye this week if you read the press on what the Fed does. Obviously, next week on the Master of Money, we're going to be talking about the Fed meetings, but those are highly important because that interest rate issue comes to bear in your investments. As I said, as we look at the financial markets, all three of the major indexes were up nicely, and they've actually moved into positive territory. Again, what's causing this is that there's nowhere else to go. How often do and I sit in the professional world of finance, I talk to people every day who say they just don't really know where to go. They don't want to buy bonds because if interest rates go up, bonds go down. They don't really want to be in stocks because if interest rates go up, stocks are going to go down. But they don't want to be in cash because it doesn't pay anything. There are a lot of other asset classes. In fact, Credit Suisse, I get some of their research. They just released their hedge fund data for the month of February. And if we look year to date, the very best performing hedge funds are the global macro people. These are funds that make investments based on the global macro circumstances around the world, and they're up for the year about 3%, so about 1.5% a month. I bring that up to you because it tells you, first of all, that there's a lot of other money being made than just buying and holding a mutual fund. There are a lot of ways to play this game. But number two, it gives you a realistic expectation on what you can get out of returns. If the very best of the professionally managed hedge funds are up 3% this year, well then if you're up at all, you should be happy. Let's not think, as I've talked to so many people who have, they have visions of double-digit returns every year. Tone that down. Over a long period of time, the U.S. stock market grows at inflation plus a premium. Typically, it's been about 8% a year. So that's a number that you ought to think about when you're looking for your returns. So I thought the Credit Suisse numbers played right into that. So as we kind of look and wrap that all up, the geopolitical world says instability. That's not new. Guess what? That's been around forever. But it's set up for some real triggers. In fact, you can go around the world and see these China's making really hardline statements against an island owned by the Japanese. The Chinese say it's theirs and they want it. They moved a carrier group near it to intimidate the Japanese who aren't backing down. It's another instability in the world. So when you look at that, you look at the Middle East, you look at Europe, all of it says, yes, go ahead and stay invested, but like the professionals, get those risk controls in place. Now, finally, I talked to you a while back about how Barbie dolls were hurting in the market for Mattel. In fact, I was on TV talking about this because the American consumer is moving away from the sweet, demure Barbie doll. They're moving into much more aggressive dolls like Bratz and other things. In response to that, Mattel has made Barbie truly creepy. What this doll now does is when your child speaks to it, it stores all that they're saying up in the cloud. In other words, up in the internet space. So the doll can communicate with your child based on what your child has said to it. Well, the scary thing about that, and the reason it's been called creepy, imagine the marketer's dream that is. Your 6-year-old daughter playing with her Barbie doll is telling that Barbie doll my favorite TV show, my favorite record, my favorite color, and Mattel is just soaking that all in. So before you go out and buy your child or your grandchild a doll that speaks to the cloud, look a little bit cynically at the other side and realize why it's doing that. I don't think this is a really smart move by Mattel, but we'll have to see what happens with it. At any rate, when we come back after the break, we are going to talk about the psychology of investing. Again, this is something that's very near and dear to what I preach. When I started doing the society and its derivative things a few years ago, one of my issues was if you're going to preach money, you have to broaden that out. Money is often an outcome of other things. And as I talk to people who come live to the Master of Money, and I talk to other people through our questions at SafeFinancial.org, it really strikes me that many of these people don't have a financial path problem. They understand the financial markets. They may understand the language and the techniques and the tactics. But where they're lacking is the emotional side. Their psychology is holding them back from being all they can be. So tonight when we come back, we're going to talk about that, and I'm going to try to put a framework around psychology and investing that can give you perhaps some insights into yourself or maybe into someone you know. So stay tuned. We'll be right back for this edition of the Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program. Once again, I'm always glad to be joining you on these Tuesday nights or whenever you watch this. For those of you who can't watch us on Tuesdays, you maybe have seen that you can replay this through our website 24 hours a day. So just go to www.safefinancial.org and it will show you right there where you can click to our network and it will replay these Masters of Money. It will also show you all of the archives we have. So if you'd like to rewatch a Master of Money program, just go to www.safefinancial.org and we'll take you right there. Now, why is it when we talk about money, something that should seem so common sense isn't until we think about it. It's often true in many things in life, but when it comes to money, it's very, very true. Why is it that some people seem to get a grasp of money and prosper, but others, even though they may intellectually have the knowledge, can't seem to get it right? What is the difference, and what can we glean from this experience to make us understand it and improve ourselves? The fact of the matter is, we have an economy that has generated more wealth than any economy in the history of the world. But we still have 10,000 people a day retiring, and I'm willing to bet you about 9,000 of those folks aren't ready for retirement. How can that be? Is it just as simple as there's some basic knowledge they didn't have? Well, let me share with you something I've learned in my life, and that is that it's often been said knowledge is power. I disagree. Knowledge put into action is power, and it's to put into action that we find many of these people fail on. We're going to talk tonight about what I call the 3 Qs of success. The fact of the matter is, a lot of our things in life come down to 3 different things. They're intermingled, they're commingled, and they're simultaneous. But we have, of course, our ability to cognitively understand something. Financial education and financial literacy can teach you what's called the intellectual quotient. I can teach you what derivatives are. I can teach you what options and futures are, what straddles are, what ETFs are. I can teach you how to go long, short. I can teach you all of these things. That's your intellectual side. But that's only one of 3 sides. We know from research into the brain and how it operates, human beings also have another side, often thought of as the emotional quotient. This is not just their ability to empathize with others, but it's also their ability to grasp their own self-image. How do these people see themselves? How do they execute on things in life that drive them toward a vision of themselves that may or may not be true? This EQ oftentimes can derail an otherwise stable IQ. Well, there's a 3rd dimension to this, and this is called an AQ, or adversity quotient. I found the research into this to be fascinating. In life, all of us start out life and we face a mountain. Some of us look at the mountain ahead of us and say, it's so big, I can't climb it, why bother trying? And those people, although they may have the intelligence, they may have the emotion set, they don't have an ability to look at adversity as a challenge to be overcome. They look up at the mountain and they see it and say, I'm not willing to even start. Another group of people says, I have the knowledge, I have the emotional wherewithal, I look at the mountain and I'm going to start climbing. What these people find is they go a fair amount up toward that mountain of success, but when they get up to a certain point, they begin to look down. And they say to themselves, oh my Lord, look how high I am. I could fall. Or why go higher? I'm already high enough. And those people stop climbing. There's a 3rd group. And these are the people who look up at the mountain and say, well, I don't know, I'm just going to take a step up. And they take one step up and another and another and another. They never look down. They just keep climbing up. These are the people that we see in the executive suites of the world. They've got the intellectual power, they've got the emotional power, and they've got the adversity fighting power. And it's those 3 things that when we come together to talk about building wealth, if one of those is out of balance, wealth will not be the outcome. As I talk to people in the Master of Money live meetup meetings, and I've talked to people around this country, many, many times I've met people who ought to be wealthy. They have the presence, they have the knowledge, they have the intellectual depth, but what they don't have is a belief that they can do it. They simply look at that mountain of building wealth and say, it's not for me, I'll never be rich. When they're asked why not, I just won't be. It's that self-image that's preventing them from becoming wealthy. It's not that they're not smart enough to get there. It may not be that they're not a hard enough worker to get there. It's purely because in their own self-image, they don't believe they'll be wealthy, and they never will. Most of us in life have one of 2 outcomes. We either run away from what we're most afraid of, or we run to what we most wish to happen. More often than not, we're running away from what we're afraid of, though, and the little gremlins that chase you will find you. That emotional baggage, that personal perception of wealth or lack thereof, is what prevents us from becoming wealthy. It's that simple. I gave a speech at the Chicago Federal Reserve about 2 years ago, and it was all on American savings, and I talked with a group of teachers and educators about the dismal savings rate in America. At the end of the speech, they asked me how I had achieved my success. For those of you who don't know me, I was flat broke at 23 years old. I had nothing. By the time I was 30, I was head of a company that would ultimately, I should say, make me a multimillionaire. The fact of the matter is that transition happened for 3 key reasons. Number one, I have a really good work ethic. And for those of you who want to build a path to prosperity, get comfortable with work. It's going to come. Whether you work at a job or you work for your own self, doesn't matter. You're going to work, and that work will guide you. Number 2, I'm very well spoken. You've watched me on this program. I practiced when I was young about becoming what I wanted to be. I wanted to be one of those successful people. Now, I was fortunate. I had very good parents, so I had role models. But you don't need to have that. We can look out, for example, when I was in my depths of despair in my early 20s, going through the transitions that many of us do, I used to drive around on a Saturday night, and I'd go into the nicer neighborhoods, and I would stop, and I would ask the people out cutting their lawns what they did for a living. I was curious. I wanted to be like that. How could I model myself after that behavior and that idea? Well, I talked with these people, and I learned that they were eloquent in the way they spoke. They weren't flowery, but they had the language down and they knew how to communicate. Well, the third thing is I learned how to self-image myself to success. I began at that time to see myself as a success. I wouldn't let anything get in the way of that. I dressed like a success, I walked like a success, I talked like a success, and I created a persona of success. When I meet people at the Master of Money and they tell me they want to be wealthy, they need to start acting like they're wealthy. They need to put themselves in a position to say, this is what I want and this is how I'm going to get there. They will find that without doing that, it's extremely difficult to get there. The way we live our life, the very things we do day in and day out that build a path to prosperity have to be consistent with a person's self-image. And the reason I bring this up tonight is in dealing with the live Master Money Show participants, you'd be shocked how often I hear people say, I want to be rich. But when you talk to them about their self-image, they don't really believe they'll ever be wealthy. And it's that self-limiting belief that will keep them from doing it. So what we're going to try to do here at the Master of Money over a long period of time is certainly teach you the EQ or the IQ. We're going to teach you what you need to know to make your money grow and to make your money work harder for you than you worked for it. But we're also going to tackle this psychology. We're going to talk about investor behavior from a couple of standpoints. First, what behavior does to the markets, and there's a whole study of behavioral finance that we'll talk about. But secondly, individual behaviors. Why is it that some of you watching me tonight will not be able to achieve the goals you set out for yourself? That's an important issue, and we're going to address this, and we're going to get to the why of why people don't do it. I've done a lot of coaching. I've done business coaching and individual coaching over the last years, and as I do that, I find that some very smart people make some very bad decisions, and they do it because there's something going on in their background that's pushed them down a path that made them see themselves in a way that may or may not be true. This is a lot of psychology stuff, I know, but it's very real. And a sound path to prosperity has not just the intellectual knowledge, but the emotional knowledge. And that's what we need to get to. It's important as it can be. And this is something that will literally be impactful on your life if you let it. Now, some of you out there may have achieved success. I would welcome you to send us your stories to questions@safefinancial.org because I'd like to share them. I'm willing to bet that if you're sitting there right now saying, you know, I achieved a fair amount of success, he's dead on. I believed I could do it and I did it. It's that self-belief that we need to instill in all people so they believe they can become a master of money? I believe they can. I believe we can universally build a better, more prosperous nation and more prosperous world. We can teach the IQ. We need to work on the EQ. Now tonight, we have a special guest, a brand new guest by the name of James DeGeorgia. He's a principal of Energy Options Advisor. He's a colleague of Jeff Garbaz at Superstock Investor. And James has agreed to talk to us tonight about gold. Now, the reason I wanted him to come in talking about the psychology of investing, there is nothing out there that plays on people's emotion of greed and fear perhaps more than gold, especially the fear component. If you go back to 2008 and 2009, the markets had dropped off 50%. The world economy had frozen. We had a transitional election in the United States that scared many people. People believed it's over, we're going to buy gold. Now, those of us in the industry said, don't do that. This is not the time to do it, but they did. And we said to people, don't sell your stocks. This is a bad time to sell. It's Mr. Potter from It's a Wonderful Life. Everybody was selling and he was buying. Well, the fact of the matter is people bought gold because they feared the economies would die, the dollar would go out of value and all that. Here's reality. The markets have doubled. The dollar is the strongest currency in the world. And gold, while it plopped way up, has come down to about $1,100 an ounce. So it's in a stable range. Remember what I've taught you in the past. Long-term, gold will cover inflation. But James DeGeorgia is an expert at making money on gold. So we've recorded a little segment on him to speak with you about some of his thoughts on the gold market. Here's James DeGeorgia.
James DeGeorgia here. I'm so pleased to be part of the Masters of Money show today. There's a lot to talk about with regards to the gold market. And in fact, it's connected also to the oil market. The dollar has been on an amazing rally the last a couple of years, and we're seeing the power of that dollar rally in gold. You know, part of the situation is emotional and has to do with a lot of headlines and a lot of fear about, you know, the fact that the dollar is not going to reverse this trend. And I think we should be looking at it an entirely different way. Frankly, the rally in the dollar should have put gold well under $1,000, even below the marginal cost of production, which is running around about $1,100 an ounce around the world. So we can see that if, in fact, the dollar was really affecting gold all out, we would be a lot lower than we are today. And so when I look at the gold market right now, I think we're really at an exhaustion point. We're at a point where we don't know what the Iranians are going to do, whether we're going to get a negotiation. We don't see a recovery taking place in Europe. All around the world, countries are devaluing, a competitive devaluation of the currencies in hopes of becoming a more competitive exporter. And so when you look at gold in terms of the euro, the pound, the Swiss franc, the yuan, the ruble, okay? It looks like gold's in a major bear market. So when you just look at it at the dollar, it looks like we're in a terrible bear market. So you're not getting a true picture. So people who are dissuaded from adding or building a gold portfolio at this point, whether you're talking about an ETF like GLD or you're talking about physical, would be well advised to exactly start to build a position now. Because this dollar strength is not going to last very long. We're going to be in a situation where we're going to have to be forced to raise interest rates in the United States, adjust the value of the dollar comparative to gold and to other currencies, as opposed to, you know, some of the bears that are saying, well, it's going to go under $1,000 and it's going to be there for a while because there's no inflation. Well, there's no inflation here in the United States when you look at it at the dollar. But if you're trading in rubles, or you're paying your bills in euros, or you're paying your bills in English pounds, you have a terrible situation that's taking place as far as, you know, inflation and what the consumer is paying. So I look at the gold market right now, you know, as something that you should be accumulating, You should understand that there have been no major discoveries of gold mines in the last 15, 20 years, no big resources that have been uncovered. And basically, labor costs are rising around the world. The only reason that a lot of these mines are still staying in business is because they're selling their gold for dollars and paying for the labor in local currency. So right now, I rate gold a strong buy at under $1,200. And I look very cautiously at building a speculative position, meaning short-term trading. This is not the time to do it. This is the time to look at the longer picture, because this sell-off is really getting way overdone. It's caused by the dollar. It's caused by the international things that are taking place. But at any one moment, we could wake up in the morning and find that gold is in fact up $100, $200, $300 as a result.
James, thank you for that kind commentary. We really do appreciate it. We want to express our appreciation to all of the people who join us at the Masters of Money. They're not compensated for their participation. They do it because they believe in the mission. And the mission is to build a wealthier society, one person at a time. So James was on here to talk about some important things you need to know. We're going to have him back. In fact, we'd like to have him live in the studios at some point. He lives in South Florida, so it's a little challenging to do. But perhaps we can Skype him in so you can see him live. But we want to thank him for joining us, and we want to thank you, of course, for joining us. We'll be back next week for another edition of the Master of Money. We'll cover another topic of high importance to you. We're out to build a better path to prosperity for everyone, and so these programs become the core of our effort to do that. As always, write us, please, at questions@safefinancial.org. Visit our sponsors, by the way, Harvest Investment Services, where they harvest gains and minimize losses, and Superstock Investor, where they provide institutional-grade research to individuals. Both of these companies have stepped up to support the Master of Money, and we thank them very, very much. So have a prosperous week. Enjoy St. Paddy's Day, and again, a little luck of the Irish for you this week, and we'll see you next week for another edition of the Master of Money.